Hello, my name is Lauren McCauley, and I'm going to go over our analysis of alternatives and our recommended solution. The first alternative solution is for Gainesboro to go with a 40% dividend payout. A couple advantages of going with this alternative is that it may project confidence in the company's growth. It would also make the shareholders happy. Unfortunately, this alternative is not in line with Gainesboro's corporate goals. The debt-to-equity ratio is projected to be higher than 40% for years 2006 to 2011. Senior management understands that there is place for some debt, but anything above 40% is unthinkable, indicative of sloppy management and flirting with trouble, according to co-founder David Scarborough. Even though the debt-to-equity ratio for 2005 is projected to be 33%, which is below the corporate goal of 40%, senior management is still talking about how their debt-to-equity ratio was 22% in 2004. So this is showing that management may not really be in favor of as much debt as they think. Additionally, Gainesboro is expecting to have an unrealistic 15% growth rate for the next coming years when considering a 40% dividend payout. Security analysts have suggested only a 5% real annual growth rate for the next coming years because of the U.S. economy. The U.S. economy is not very encouraging. The second alternative is paying out residual dividends. This alternative solution would allow Gainesboro to build trust with its shareholders by showing them that they are investing in a venture with a positive net present value. This would give them confidence that they will eventually make more money in the future on their current investment. However, this alternative is very unpredictable. Some years, a dividend may not be paid out at all, which could cause negative pressure on Gainesboro's share price. Additionally, based on a study conducted by John Linter, companies that enter a high growth phase, such as Gainesboro, tend to pay out lower dividends. This could be because they need to fund the high demand of their products. Our last alternative solution is going with a zero dividend payout. This alternative will allow Gainesboro to preserve their cash, and it is the strategy that is most in line with their corporate goals. However, it does come with some risk. They risk making their shareholders very unhappy and potentially losing some. However, having a zero dividend payout will allow Gainesboro to have a debt-to-equity ratio of less than 40% for years 2006 to 2011. Gainesboro can put the money that would be going to shareholders back into the company to support its goals of expanding internationally and acquiring small software companies. Additionally, having a zero dividend payout will allow for more flexibility within the research and development division. This is especially important because Gainesboro is expecting its competitors to release similar products within the next 12 months. In order for Gainesboro to keep its leadership within the market, it must keep up with the latest research and development trends. After analyzing all three options, our recommended solution is to go with the zero dividend payout. This option is most in line with Gainesboro's corporate goals and will fund its plans during a high growth phase. Additionally, it will keep its debt-to-equity ratio below 40%, and it will help fund its growth internationally and also while acquiring small software companies. Thank you.